for merchandise, right? They give us March's, that was given to us, wasn't it? 21,750. They gave you April's purchases. Half of it is paid for in April, half paid into the next month. So we're just going to take that and add the other information that's required. So that was given in May. How much do we have to purchase? And we're going to pay half of it in May, the other half in June, isn't it? And that's the required purchase in May. Half will be paid in May, half will be paid in June. And then here's June. Half of that will be paid in June. And the other half will be paid in July, which is the next quarter. So it's not going to be included here. And then we just bring everything across to determine the total disbursements for the quarter, the total disbursements for each month for merchandise purchases. All right. Everybody good up to this point? So you guys need to kind of chime in when you have a question or a problem or a difference. All right, then we're moving on to the next page here. And we have to do a cash budget. That's a favorite of ours, isn't it? So let's just walk through cash budget. We start with the beginning cash balance. We add cash collected. Well, we have a schedule of expected cash collections. That's already done for us. They tell us, didn't they, in the problem, what the beginning cash balance was? Somewhere in that information, they give it to us. Oh, well, we could look at March 31st data, current assets, cash shows $8,000. There's our starting point. So $8,000. Oh, all of this is pretty much given to us, right? And then the collections for the month of April is 56,000. So the total cash available, 64,000. Then we have disbursements for inventory, for other expenses, and for equipment. Now, other expenses, did we do that yet? Or didn't they require that to be done? Let's see, schedule of expected cash disbursements, but they didn't ask for all of the, so we had to figure it out, right? So we have our cash disbursements. Here's our total cash disbursements. We compare them with total cash available. We have an excess of $1,350, but they require what? A minimum balance of $1,000 or $4,000, and they borrow in increments of 1,000. So they couldn't borrow the exact amount to end up with 4,000. They had to borrow 3 increments of 1,000 or $3,000, and so their ending cash balance is 4,350. Did everybody read that carefully and put it that way? Excellent. So the ending cash balance becomes the beginning cash of the next month, May. And we had our expected cash collected for May. We add it to get our total cash available. For inventory, we have 58,500 disbursements. We see that from our budget. For let's see, they have it here somewhere. Monthly expenses, they show salaries per month, advertising, shipping, 5%, etc. So those expenses, and it's not including depreciation. So we get that calculated, and then we get our total disbursements of 73,960. Ooh, we have a deficiency. We spent more in cash than we brought in. So we got to borrow some more money. So we got to borrow $3,000, right? Or look, they're saying no. If you want to get a $4,000 minimum, you got to borrow 7. Ah, very good. So We borrowed 3,000 in the month of April. We borrow another 7,000 in May. So our ending balance of 4590, we bring it up to the top. That's our beginning cash. Added to the cash collected, total cash available. We subtract then our cash disbursements on inventory for all of our other expenses, excluding depreciation, and we get total disbursements. Now we have an excess of 15,140. Well, we can pay back the 3 and the 7, so that's 10 we can pay back. And we still got enough to pay back the interest. 1% on $3,000 is $300 for the month of April, and also for the month of May and the month of June. That'd be $900. And then we have question.
I have a question, Ed. With the financing, it says that you can only do 1,000 and it's for each month. But because we weren't able to pay it back on May because we had a deficit, is that why you didn't pay it back until June?
Yes, because the problem,
Okay.
doesn't the problem state? Here, let me see if I can find it here.
I'm just asking, like, if I was to make more money in May and able to pay off what I had borrowed in April.
You could,
okay.
but in this problem, they could not because they had more cash being paid out than what they were bringing in, so they had to borrow some more. So generally, a company does get a line of credit, a revolving line of credit, so then they can tap into the amount they need. So they do this in advance. They make arrangements, so then they're not scrambling at the last minute to try to cover expenses that need to be paid. So that was all stated that, hey, we borrow money when we do it. We borrow it at the beginning of the month, because if you have a budget, look, based on our budget, we're going to be short cash, so we better borrow the money at the beginning of the time period. So they had to borrow 3,000 April 1st, so they're being charged 1% a month. So that's $300 interest for the month of April, 300 for the month of May
30.
and June, because you're paying it back at the end of the month. All right, but then the 7,000 got 2 months. You got that would be $700, $1,400 in total.
It's
plus
only 30.
What's that?
It's only 30 in interest, not 30.
Oh, that's right, 1%.
1%.
Yeah.
Yeah.
So it was $30. Yes, 30, 60, 90. Okay, so it's
cost, baby.
$230 in total. So we're going to subtract not only the repayment of the principal, but also the interest. That total repayment is $10,230. So the ending cash balance should be $4,910, and should be right there because that's the end of the quarter. And you got to make sure you do this correct. So what's the beginning cash balance for the quarter? April 1st, they have 8,000. Students make this mistake all the time. They just start adding every single number across. You gotta read what it says. If you're here in this column, talking about the quarter. So what was the beginning cash balance for the quarter? That would be the first day of the quarter, April 1st, and it happens to be the beginning balance of April. It has to be. Now, what's all the cash collected? Well, you have to add all the cash collected for each month, and that gives you the total. So you add that to the beginning, that gives you the cash available. You subtract out what you paid cash going out. And remember, depreciation, amortization, and depletion does not get paid out in cash, so it's not going to show up on the cash budget. All right, they told us the expenses excluded depreciation, but some problems, it'll include depreciation. You got to subtract it out. So you add these cash disbursements to get the total, subtract it from the cash available. We have an excess amount. We borrowed 10,000 during the course of the quarter. We repaid 10,000 during the course of the quarter, and we had a payment for interest of 230. So cash coming in the financing, cash going out for the principal, that's a wash. What's left is the interest of 230. Subtract it from the cash available the excess, and you better get the same number or there's a mistake made. All right, so there's your check figure right there. And remember, I always put the beginning balance. And that would be the first day of the first month of the quarter. Does it seem pretty basic for you? A cash budget. So on the exam, you got a blank sheet of paper. Can you write everything down? Well, it seems pretty easy. Your beginning cash collections gives you the total cash available. My disbursements, I'm going to have disbursements for purchases. I'm going to have other expenses where I got to pay cash out. I may be paying dividends in 1 or 2 months. I may be paying for equipment, etc. Those would all be cash disbursements that need to be total your cash disbursements, compare them with your total cash that you collected during the month. You either have a deficiency or an excess. If you have a deficiency, then you got to read the requirements of the problem. What's the minimum cash balance they want to maintain? You figure out the deficiency you have plus what they want in a minimum balance. So if they want 5,000, you got a deficiency of 2,000, you got to borrow 7. So it'll eliminate the deficiency and end up with the minimum balance. And then that goes to the top and you do it again. And then you do it one more time for a quarter. And then you got to know how to bring the numbers across. Is it that simple or do I make it sound simple? Oh, it'll be simple for you. You just have to do it over and over again. Do you know how many times I've done it over and over again? Many times, right? But if a guy like me, who's nothing special, can do it, you too can do it. All right? That takes care of that. Now, let's see what else they have. Schedule of expected cash disbursements. Oh, cash disbursements for merchandise purchases. So they give us December purchases of 93,000, January's purchases of 135. Oh, and you're paying half of it, right? In the month and then into the next month. So then let's go ahead and see how you did. Let's see if I can find that page. Oh, do. For some reason, I'm missing that page. How come I'm missing it? 3, 4. I'm missing 4. They ask, am I reading this wrong? B, schedule of expected cash disbursements. See, we should have done that already, right? Cash budget. Oh, we did the cash budget. Did I already do this disbursements? I did, didn't I? Yeah, I did that one already.
Yeah, the next should be the budgeted income statement.
Yeah. So yeah, because 3, we did the cash budget. Okay, 4, using Schedule 9 as your guide. Prepare an absorption costing income statement for the quarter ending March 31st. So I hope we're starting to learn the difference between a required income statement for financial statement purposes, for financial accounting requirements. When we publish an income statement, we have to use the absorption costing, which states that we must absorb all manufacturing costs, right? And make it part of the product. We're not manufacturing anything here, but we're buying it already made. So that would be our purchases, wouldn't it? So we know what our sales are for the quarter. We have our budget for sales budget. And the 3 months, we have 222,000. Cost of goods sold, could we take a calculator right now, 0.75 and multiply it by 222,000? Justin, can you run the numbers since I don't have my calculator with me? 222,000 is your sales. If you have a
There's
gross margin, if you have a gross margin of 25%, then cost of goods sold should be 75%. And what you get, Justin?
166,500.
Oh, you do. So do you see how I could shortcut this by just multiplying it by 75%? But you do take your beginning inventory, add purchases, gives you goods available, subtract out ending inventory, and you get it both ways, don't you? So you might have did it this way and then just said, oh, I know it's supposed to be 75%, and you could double check yourself, right? So if on the exam had all these detailed information that you have to plug in and, oh, you know, it's 75%, you could do a quick check, couldn't you? 75% times 222,000. So there's our gross margin, or you could even shortcut it 25%. Gross margins 55,500. Then we have our selling, administrative expenses, rent. Depreciation gets shown on the income statement, but not on the cash budget. Students sometimes fail to put it down on the income statement. But remember what we're doing, a cash budget. Depreciation, there's no cash going out when we calculate depreciation. It's just a means of rationally allocating the cost of an asset over its useful life. So we get a net income of $5,110. How many students had it? Raise your hand and I'll just scan through. We got 1, 2, 3, just 3 students. So it's a little bit of a challenge, isn't it, to do everything right? Cherie, you didn't get it. I was surprised. You're usually one of the ones that get it. So did you get my email on your question that you asked last Friday? Okay, you're welcome. All right. Anybody have a question with that? Or you knew you made a mistake in one of the other schedules, that would cause a problem, wouldn't it? So, oh, look, they even put in their solution a simpler way. You know, that's right. Nobody needs further clarification. Everybody's good. All right. Then the last thing they want is a pro forma balance sheet, right? Or a budgeted balance sheet. That's another term for a budgeted financial statement, is a pro forma balance sheet. So you might see that in the multiple choice or in a problem, especially if you take the CPA exam. You got to know the terminology. Same thing, same meaning. So this is what they have now. Cash, $4,910 comes off the cash budget, doesn't it? Accounts receivable, 40% of the last month's sales, right? So that would be June, because it was April, May, and June. 90,000 was the expected sales. 60% collected in cash. The 40% collected the following month. So that would be your accounts receivable. Inventory requirements, yes, the ending inventory, 28,800 total current assets. Building and equipment net, you had to subtract out the additional depreciation for that 3-month time period, didn't you? Liabilities, you got accounts payable because of your purchases on account of your merchandise. Stockholders' equity, there wasn't any additional shares sold. Retained earnings, oh, that includes the beginning retained earnings plus the net income for the quarter. And we get the ending retained earnings, and we get the balance sheet to balance. We always like to get the balance sheet to balance. All right, we covered the problem. It doesn't seem to be much of a problem. People didn't have questions or concerns, though not many people, I think 3, did I say? 3 or 4 hands had it right. So what questions do you have regarding budgets? Can you do a master budget? Should we do a whole master budget on the exam? No, that take way too much time. So the one we're going to be doing is the cash budget. You got to know that inside and out. However, the other budgets are going to be tested in the multiple choice questions. So you still have to know those.
Ed, in the income statement, the balance sheet, where do the accounts receivable accounts come from?
Okay. Well, let's take a look at the first page. I'm sorry. The first page shows the current assets and the other assets and liabilities and stockholders' equity. But at the top of page 407, they tell us sales are 60% cash and 40% on credit. So $90,000, that's the number of dollars they expect to sell. Of the 90,000, is $32,000 or is it 36? What is it? 90,000 times 0.4. Isn't that $36,000 for accounts receivable? Does that make sense to you, Justin?
Yes, I just wondered where the 90,000 came from.
90,000 is on page 407. That's your, so all that information, they give us the actual for March, and then the rest are budgeted. And they tell us in letter C, sales are 60% cash and 40% on credit. So that means 90% of those sales, we did not receive cash. Customers owe us. And they tell us that the credit sales are collected the following month. So the rest of those, of the 90,000 minus the 36,000, that would be collected in July. So does that make sense now, Justin?
Yes, it does. Thank you.
Sure. It's good to have questions because sometimes I can answer them and help you. But if you don't ask the question, I can't help you because I can't read people's minds.
One of the things that took me a long time to figure out was the first one that we did, the schedule of expected cash collection.
Yes, tell me about it. Why was that such a difficult endeavor for you?
Because it says cash sales, I assumed it was the sale amount, not realizing.
Wait a
that it
second.
was
Wait. So
collection.
are you looking in the book like I am on page 407? It says, using the preceding data, complete the following schedule. And it states schedule of expected cash collections. And then in that, it already gives you April's cash sales and credit sales and total collections. So then you must not have read carefully in the data. Maybe you couldn't remember all that stuff that I read, but it's saying cash sales. Okay, let me go back and see. Sales are 60% cash. So April has 60,000 times 60%. That would account for the 36,000 cash sales, right?
Right.
And then it says 40% on credit. And then the next sentence says credit sales are collected in the month following the sale. So that means the April sales, 60,000, we have 60% or 36,000 being collected in April. The rest of it, the other 40% is going to be collected in May. So then what are the credit sales collected in April? That's why they gave you March's actual sales, because half of it was collected, or I'm sorry, 60% was collected in March, and that means 40%. So what's 40% times 50,000? 20,000 collected in April. See? So your job was to do your due diligence. How did they get those numbers? It was based on the data given, and it might have taken you a little bit of time to read it and reread it to make sure you understood it.
Yes.
But but now that you have experience, if you have a question on the exam to do a schedule of expected cash collections, you have experience to draw upon. And you kind of know what you're looking for. You know, you're looking for, are there any cash sales in the month? Okay, what are those? And then is there any credit sales? What's their credit collection policy? What do they have? Oh, it's every 30 days. Then we expect in this month, 30 days later, will be collected into the next month or whatever, right? So that's okay, Vanessa. You need experience. And that's why you did this problem, to gain that experience. So next time you have to do a schedule of expected cash collections, you can draw upon that experience. And like me, I've been doing it for years. So I got it down pretty good. But maybe you don't want the job I have. Can you imagine having to do a master budget every semester? Well, it's not so bad when you do it so often. Okay, what other questions? People don't like to ask questions because I tease them, I guess, huh? All right, then you know what chapter 8 is all involved. And if you didn't do very well as a coach and as an instructor, I would say you need more practice. So get the pencil and paper and redo the problem. It won't take you as long this time around, and you'll gain confidence because I did it, took forever, and I didn't get it right. Now, you don't even have to have it nice and neat. You could just use my chicken scratch and write all over a piece of paper and just double check your numbers. So you could probably do this in a lot less time than the first time around. I'd say all of you could do it in 2 hours or less. Some of you could do it in less than 1 hour. And then somebody like myself could do it in 30 minutes. But it gives you practice, number one, and which the old saying goes, practice makes perfect, doesn't it? And the only way you get better at a skill is by doing it. So by doing it now, that's one more time you have it done before the exam. If you wait until the night before the exam, you got a lot of practice to do, which is overwhelming for my exams, I think. All right. So I have nothing further. So I'll stick around if people have individual questions or whatever. We're going to be getting into the next chapter, which takes our budgets, our master budgets are static. They're static. Now we're going to turn a static budget into a flexible budget. And remember, write this down in your notes as something that you have to master because students somehow forget. The only thing flexible in a flexible budget are the variable costs. The fixed costs are fixed. It doesn't matter how many units are sold or how many units that are produced. It's fixed. So the only thing variable are the variable expenses. That's the only thing flexible in a flexible budget. All right. With that, you can go unless you have questions. And I'm here for you.
Thank you, Ed.
You're welcome, Vincent.
Have a good day.
Yes, Vincent. Thank you.
Ed.
Ed.
Have a
All
good
right.
one, Ed.
I will, even though I'm giving. All right. I think you're trying to make something up because let's look at the problem. Let me see if they even tell us right at the beginning. It's a wholesale distributor of consumer goods. So do you know, Cherie, what a wholesaler distributor of consumer goods is? No, they don't make anything. They don't make anything. Yeah. So they might represent a bunch of different clothing manufacturers, right? And they can sell to Dillard's. You know, we represent these name brands, and so you can order all of these things from us. They don't make any of it, right? So wholesaler and retailer wouldn't have finished goods inventory. They wouldn't have raw materials. They wouldn't have work in process because they don't. It's only manufacturing companies do. So if we're a manufacturing company, then we would have finished goods inventory. We'd have raw materials inventory. We have work in process inventory. So don't give me ideas about coming up with a manufacturing company for the exam. It just might be too much. Yes. So did you have your accounts pretty much the way I suggested you have them? Because I thought I read you where you called rental income an asset. Or maybe the company A didn't have the building on their books and the owner was maintaining ownership, and so the rental income was going right to the owner. So I didn't know. I just say those things because that changes for the that changes things for a year. Am I right? So do they have a record of it so that company A would show an asset building being debited, and you could see the transaction if they paid cash or if they had a mortgage on most of it or all of it. So they had that transaction covered. So then company A did have that asset building. So then company B was just renting their portion of the building and paying company A the rental income. You probably figured it out after. Well, mm-hmm. Wait, razors? You mean razor? Okay. Yeah, I got you now. Okay. Okay, fix the asset or fix the person that was riding it. Okay, so the person riding it takes on the liability if they get injured. They yeah, okay. So then that gets the company off the hook. Okay. Yeah, yeah, right. Expenses, yeah, repairs. Right, because it doesn't make the razor any better, more efficient, or extends the useful life. It's just repairs to get it back to where it was at. Exactly. Yes. And what kind of do they have to be oiled or whatever that they probably have to adjust the carburetor or whatever. All of that would just be normal, ordinary operating expenses. Well, so they include, they keep track of people inside the company repairing it, and they also keep track of if they take it to somebody outside and they get billed for that, right? So they want to know, they want to, I don't know if they do this or not, but then they could set up repairs done in-house, you know, and keep track of those expenses for internal purposes, because you're paying that individual either a wage or a salary for working for that company. You can't show another expense because you already paid him or her to do that work. That's part of their salary or part of their wages they're doing for the company, right? So you can't show it twice. You can't show, well, we pay wages of this much, and then this person did this work on this, and we're going to say repair expense. So it'd have to be in addition to the cost of what they're paying the person. So that person might use, I don't know, might have to buy parts to repair it. Well, then that would be part of the expense. So, and that's here in town, the company. Oh, okay. So yeah, it's a rental company. Is that the only thing it rents out at the moment? So they can, it's a nightmare to account for it. Are they making any money off of it? That a side business. Yeah. So it isn't worth it almost to have. Yeah. So like my friend, he bought a hotel in Marble Canyon, and that's near Lee's Ferry. And what he does, I mean, he makes, you know, he doesn't really make that much money on the hotel. It only has 12 units. But what he does is he rents kayaks to people. And a lot of people are staying, they hear about, oh, you can kayak Horseshoe Bend. And so they'll take people in a truck, they'll load up the equipment, and they put them in the Colorado River, and they get to kayak the Colorado, and they get to go around Horseshoe Bend, which is pretty cool. And so they make like 3 to 4 times the money doing that side business than they do at renting out the 12 lodges they have. So yeah, so that's, yeah.
There's a
He
lot
says
less maintenance on that too.
yes, a lot less maintenance, and he's had to bring the hotel he brought up to code because the people just kind of ran it into the ground. But it's funny because that community, there's not that many people living out in that area, but Marble Canyon is beautiful. And then he advertises on the web. And if you're going to go to the North Rim, you might want to spend one night at his place and kayak the Colorado, and you go around Horseshoe Bend. You could take pictures. That would be an awesome experience, right? And then the next day you drive the rest of the way to the North Rim of the Grand Canyon. So yeah, he's done tremendous business. He's been doing it, I think, over a year, maybe 2 years. And then there's another hotel, kind of maybe a little bigger, and he started renting kayaks because he saw how Brady was making so much money off of it. And then now he's suing Brady because his hotel is called the Horseshoe Bend Hotel, and Brady has in his advertisement on the web page says, what's it say? It says kayak Horseshoe Bend, and then he names his company Kayak the Colorado is the name of his company. And so the guy that has Horseshoe Bend, he says, "You're using my name." So he's suing him. But Horseshoe Bend is a natural phenomenon that he's not using their name. So I don't think he has anything to worry about, but he has to talk to a lawyer and all that. And they charge like $400 an hour. Anyways, yeah, you get in business and you got liabilities and you got to hire lawyers to cover yourself. So that touring company, if it isn't profitable, if it's more of a headache than it's worth, they'll probably quit renting those ATVs, I would imagine. Yeah. 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 Like almost every day, right? If I don't know how many do. Oh, is that all? You don't have a lot, just three. If you had 30, if you had like 30 of them. Wow. Yeah, it's just the people abuse it. Like I did a vacation in December in Utah, Moab, Utah, and there's canyon lands. There's all kinds of places people would want to have an ATV to be traveling off road, and they do, and they rent them out. You know, there's lots of places that rent them out, and